And this is part 2 of chapter 6 now we are going to talk about different methods or approaches in measuring GDP. So I already told you that there are two methods. In measuring GDP. One is to ask that how much people are spending. This is called Expenditure Approach. An alternative way is that to ask people how much they are earning. So this one is called Income Approach. So the whole idea behind this, remember that we said that it's the value of the output or market value. So the output at aggregate level is equal always. So it's triple line, not equation, it's identity. It's always equal to the aggregate expenditure or its aggregate income. So all of them are aggregate, right? What it means that the first law of thermodynamics is here. If we have different groups of people or the boxes in the flow diagram, as we said, the arrows comes in equivalent, the arrows goes out. So if it's two arrows goes in and one arrows goes out, or one arrows goes in, two arrows goes out, it's always, if this is A, this is B, this is C, the A is always equal B plus C. Or if it is D, E, and F, D plus A is equal F, because the national accounting is actually measuring the energy or mass content of inputs and outputs. In fact, we already noticed that we cannot deal with the quantities, we are dealing with the monetary dollar values of them. So dollar value in, dollar value out, always and always are equal in every knots or every reactor or exchange, energy exchange components of the circular flow diagram, of economy. So in circular flow diagram, this is always true, and you can just forget about the physics and the laws of thermodynamics. If one person is buying, it's spending, but it's someone else's income. So income at country level should be equal to the expenditure. Like you go to doctor and you pay money, and this is your expenditure, but it's the doctor's income. You go to groceries, you spend, it is your expenditure, it is your the retailer's income. Or you go to work and you are basically offering your service as the employee, and then you receive income, right? So it is for the company, it is an expenditure, and for you it is an income. So it's always at aggregate level This is true. This is true that overall income and overall expenditure should be equal. So let's draw the circular flow diagram again to make it better understood. So in the circular flow diagram, we had players of the game. We had firm, and we had here the household, and here in the middle we had the government. Okay, and then we had the same, I can say, firms of other countries, governments of other countries, and households of other countries. So we called it rest of the world. Okay, and then we had markets. We have product markets or goods and services market. Okay, and remember we said better to make a distinction between input markets, labor and resources market. So land and labor, and the capital market we put it separate because macro economy, capital or money market. So the green circles, we have three major markets. Actually, this can be split into labor market, then land market, then other raw materials, such and such, but we put them all in one. Only we separate the money market. And the physical flow goes this way, so I can show that goods and services goes this way, and these people are buying it, and these people are buying it. Okay, so it goes this way, but the physical flow is not important, and the physical flow of factors of production goes this way. So they have labor, they are owning labor and capital and resources. They are the one who owns them, and they are bringing through the physical flow goes this way. But this is not useful. Maybe environmental economists are doing this, or energy economists are paying attention more to the physical flow. But in macroeconomics, I should use the eraser to remove. Oops. So I have to be very careful when I'm deleting something from. And this is gone. And let me bring back the circle of the goods market here. So we are going to show, the arrows are going to show the money or dollar flow. Okay, the dollar flow. The dollar flow is going to be used with the arrow, and it's not going to be clockwise, it's going to be counterclockwise. So it's going to be going this way. So the main flow is that, of course, the money after they sell, it's coming here, and then they use to pay the factors of production, and it goes here, and it goes here, and it ultimately comes here. So this is the main flow, and if there is no basically flow out, any other flow in, flow out, this is balance, and the laws of thermodynamics is here. So the value of them, this is basically that GDP. The GDP is the total summation of the price of the market multiplied by the quantity of final goods, and I goes from 1 to n, Or if this is difficult, then we can say that we will count how many firms are there. We ask them for their value added, and we count over J, and J is the number of firms inside the country. So this is basically the approach. Let's call it the approach 0, because the book is saying two methods, income, and so we have 0 value added method, and then we have number 1 expenditure, and number 2 income. So for this, we are splitting this diagram into 2 parts, the upper flow and lower flow. So I put it like this. This is hypothetical. If you're in the goods and services, you're asking people, who are you asking? There are 4 groups of people. Firms, government, household, and other countries. They're spending on the money. So I will change this one, because this is basically expenditure. How much household has spent on the buying final goods and services. So this one I call it C, or consumption expenditure made by the families. Okay. I may ask the government, the government is also buying something from, of course, the government is buying stationery, they buy goods and services for their service provided to the community. So this is the government expenditure. I use the G. And how about the firms? Are firms also buying goods and services? Of course, if they go and buy durable goods for the sake of adding to the capital, that is their investment, right? So they're buying final goods, they become the final users. So if they buy for the sake of accumulating the capital, or letting the capital work smoothly and well, this is called investment expenditure made by the firm. And if the foreigners are buying from us, so the flow of money comes here, that is the export. And if we buy from them, it goes up this way, this is import. Or we can basically mix them and say that this is a two-sided arrow, and X minus M, import minus export. Which way the arrow is ultimately is moving, money comes in or going out more, it depends on which one is larger than the other one. So if I ask the players of the game, these 4 rectangle designated groups of people, all together it forms their aggregate expenditure. And the arrows come into the circle should be equal to the arrows go. So if I measure it in this way, the GDP using the expenditure approach, GDP using the expenditure approach is the C plus I plus G plus X minus M. Okay, so this is the expenditure approach. And the income approach is also easy. So it's who the land labor capital is being offered through the input market to here. So it is basically labor. Sorry, let me change the color. and here this time we are using there are 4 categories of income which the money is flowing this way. The money is flowing this way. So I will change the color of this arrow, and perhaps I should use the green better. The green, it's coming this way and it's going this way. Okay, so the payment to the labor, the payment to the capital, the payment to the resources or land, and the payments to the entrepreneurship. Each one has a different measure, and let me use the red here just to the payments to the labor is the wages, the payments to the capital is interest, the payment to the resources or land is the rent, and the payment to the entrepreneurship is the leftover. They are selling and they pay the other resources, and they are the job creators or the owners or the managers of the, so they take the remainder, which is the profit. So all together, this is flowing this way through the input market and going this way. Maybe the interest is a different one, and interest is paid for the capital. The capital is something which is every year something is being added to it. So if we are now in time t, and last year is now t minus 1. So the total magnitude of the capital is actually in time t is the capital in time t minus 1 plus what is being added to it. That's the investment. So this investment is going to be added, and usually the reason that we are using the interest, it is actually borrowed from the capital market, or so where if they buy it from here, there should be a supplier, and the supplier are basically again mostly families, which I use the green again, is doing the saving. So we use this save and we use this one I. So the I then is borrowed, and then they go and buy final goods for the sake of adding to the capital stock and make the new capital stock. But one thing is interesting, that this is not the net investment. So the meaning of the DG is the reason that we call it gross domestic product is because this is gross investment, and actually this then it's not correct, because if you want to really know that how much is added, you have to put rather the net investment here. The net investment should be here, and the net investment is the gross investment after you deducting the depreciation. So I'm going to explain this one shortly, but you can see that the flow diagram helps you to understand both income approach and expenditure approach, as well as the value added approach. So the value added approach, so you just do the head counts of the value of the final goods and services. So that's the value added approach, but it should be exactly equal to all the arrows coming inside the market, and that is the money which firms, families, government, and rest of the world are spending buying these goods and services. So from the expenditure approach, C plus I gross plus government spending plus export minus import is going to give us the gross domestic product. And ultimately, the value come in is going to be, so I should actually remove this now because they are going to be exactly the same. So this is exactly, this blue line is exactly equal to the total sum of the expenditure. So we say that the upper flow is the flow of expenditure. And the lower flow, the green, is the flow of income. And these are theoretically identical, as I said, as I said, the output is always equal expenditure and is equal to the income made by citizens of a country or in interaction with the rest of the world as well. So we've already finished actually, they're all in one go. That's why I give so much value to understanding the circular flow diagram. So expenditure approach, there are 4 categories or 4. And by the way, you should see that the GDP, then income approach is W plus I. So all these should be equal to this. Let's call it Y. Y is equal all of them, and Y is equal all of them. And pick up a one box. Here we have income is coming here, and income is going out by spending or saving. So the Y should be equal to, and this one we call it disposable income actually. Disposable income is equal consumption plus saving. Why do we call it disposable income? Where the money comes to the government, I had totally forgotten this. The government is collecting from income tax, so in the middle they charge the customers, and this one is called tax. So up to here, if this is Y, is up to here is still Y, the arrow in, arrow out, and after this knot is become Y minus T. And the Y minus T is what we call it as disposable income or after tax income. And arrow in is the disposable income, arrow out is consumption or saving. So in chapter 8 onward, we're going to explain the behavioral relationship between these macroeconomic aggregates. But at this stage, we just follow the first law of thermodynamics, not even the second law. Only the first law of thermodynamics is enough to do the accounting. And accounting is basically has to be balanced. It's accrual accounting system. If something is been spent for someone else, is generated income, and vice versa. So there are 4 groups. Group 1 is the household. How much do they spend buying final goods and services? It's called personal consumption expenditure, and we showed it with the C, right? And gross private domestic investment is I, or gross. So that's the word gross is very important. The reason we call it GDP, it's because this is gross investment. If it is net investment, then it's going to be called net domestic product. So soon we are going to come to this. And so this is the number 1, the number 2 spender, number 3 spender is the government. What the government spending? The government spending is called government expenditure. So government consumption and gross investment. So the government is also like private sector. part of their spending is called consumption expenditure, government consumption expenditure. Part of it is like investing on buying, building a power plant or building roads. These are like investing for more than one period. They may borrow or they may actually use the public taxes to do that. So this is basically together it's called government expenditure, government spending. And the net export is export minus import. So altogether the expenditure approach is like this equation. So this is actually for 2017 US GDP, and you see that it's all measured by billions of dollars, and C is actually got 3 components, G has got 3 components, and the I has got 3 components. Government spending has got 2 components, federal and state or local. And net export, of course, has got export minus import. Should be, I think this is a mistake. This should be export and this should be import. So I will correct it here. Import. And in the book, it's like im. Okay. And which one is bigger? It shows that the country is net importer or net exporter. So in the US, we see that the personal consumption expenditure is about $13 trillion. So it's all of them is the billion. So it's become $13.4 trillion. And this comes durable goods. So tangible goods, which you can see, refrigerators, car, computers, TVs, families are buying. This is durable goods. And this is about $1.5 trillion in the US. And non-durable goods, these are the food and beverage and things which are immediately consumed. So the durable goods stays for more than one period, whereas non-durable goods is within a period of time, it's going to be over. And this is actually about nearly $3 trillion in the US economy in 2017. And services are intangible. The difference between goods and services is that you can touch the goods, but you cannot touch the services. You can understand it, like teaching, like banking services, like shipment. In shipment, in transportation, nothing is going to be created. They just carry one item from the firm to the consumers, like tankers, which are carrying the petroleum products from refineries to the petrol stations. So those tankers are not creating something new. Displacement is a service. Or insurance and etc. etc. Okay, education is a service. Public health is a service. You go doctor don't give you a commodity. I mean, maybe pharmacy is medicine is goods, but the service which doctors choose the right medicine, this is a service. Okay, nothing is been given from hand to hand, but it is intangible, but it has economic value. So that is actually in the US is the bulk of it. It's about $9 trillion. So if you add them all, it becomes 13. And I'm gonna come to the percentage shortly. Followed by this is the gross private domestic investment, the arrow which is going from the mostly from the firms to the but it does go part of it from the household as well. So I'm gonna say how. So when they are making this, they were designing this, if the families buy a house, is it their C No, it's going to be considered as I, as the I. So residential, it's new houses, is considered as investment. Non-residentials are basically by the firms. So only the residential, which is investment on their buildings, in their houses, is, as long as it is new, it's going to be recorded in the I. And another thing is the changes in the inventories. Remember that I told you that the firms may produce something and not be able to sell it. A firm is producing this much, but they can only sell Q1 and this Q2 is unsold. Okay, so this is going to the families, okay, households, but this is remaining. But because it's been produced this year, it must be inside the GDP. So these are going and sitting in the inventories. And it's categorized as the gross investment. So it's sitting in the shelves, and because it's produced this year, it is the GDP of this year. So unsold production of this year is still in the GDP. So whole this multiplied by the prices, including the one which is going to be sitting here to be sold maybe in the next period. It's going to be considered as the GDP of this year. So this is called changes in the business inventories. This is a part of investment, domestic investment. And the government spending in the US system, it's a federative system. So some is in the Washington, D.C., some are by local and state government. Altogether, how much they have done in the developing projects, that is the investment made by the government. And some of them, the papers and inks or tables which they buy for their offices, that is the direct government consumption expenditure. Okay, so it's part of it has the nature of the C, part of it's got the nature of I. So the G might be actually two types. But here we are classifying, is it done by the federal government or is it done by the state? So in Oman, we have provincial expenditure by the local government, and we have the central government spending. Okay, maybe the systems are different. We should not compare our system with the US, but in the US it works this way. In Iran is different. In Australia it's a federative system, etc. And then we come to the import and export. Look at the import and export. United States is exporting 2.3 trillion, but importing 2.9. So this minus this is going to be negative, and the negative is being the difference between this. So US is a net importer because import is larger, in dollar term, is larger than the export. So it's a net importer. But if you check the net export of the Oman, it's going to be positive. It's going to be positive. Except like in Saudi Arabia in 1980s, mid-1980s, that it became negative. Oil producing countries, most of them have a positive net export. And if you add this column, this is basically nearly $20 trillion of GDP in the US economy. And if you divide this by the total GDP, that is giving you the percentage. So C consists of 70% approximately, whereas this is 17%, and this is like another 17% here, and the remainder is about because I gave it to there, maybe I should put this one as 16. So it's about 2% here, okay? Sorry, 3%. If I gave 1% more here and 17, so the total sum of these should be exactly 100%. I try to round it up, so it may not be match. You do it, and there's yet another percentage of how much of this out of the total. So you divide this by that. So durable goods is about 7.6% of the total consumption expenditure, and this is larger. So in the US, services is about 50% of the total consumption expenditure. So you play with it, and this is basically the way that expenditure approach is measured. And there are several questions, and in the definitions are put here. So the durable goods, non-durable goods, services. And investment. I told you that I'm going to come back to this and talk about the G of the GDP. The G of the GDP stands for, because the investment, there are two types: net investment and gross investment. When you are buying an investment, when you are buying machines and equipments, okay, you buy a device, okay, you buy a car, you have to spend some money to keep it running, like changing the oil, changing the filters and tires. So you're spending something in gross, so as this car works its lifespan properly. If you don't spend on these things, your car dies faster. So the engineers who have designed this, they say you have to spend certain amount of money for replacing the parts, and every durable good or product is subject of depreciation. Even human is a durable product of the nature. We are gradually dying, isn't it? So this is basically, according to the physics, this is the second law of thermodynamics. Or the entropy law. So if the car, the designer says that it can work for you 10 years if you spend such and such, so you have one car spending this much in gross, this car is working for you for maintenance, for changing the spare part. Otherwise it's gonna be dying faster, so maybe it's in 2 years becomes a garbage, you have to throw it out. Okay, for the economy is also the same. All the capital, the stock of capital T is how much the capital you had it from the previous year plus the new new devices or new machines and equipments. But every machines and equipments, they gradually die, right? They're dying out, they wear out. This is also wear out. So these new machines are called net investment. It makes us more productive. If you have more machines and equipments, labor can work and produce more output. So in the production process, depends on how much stock of capital in time t is, and how much the labor is going to be employed, and how much the materials they're using, then they can produce the GDP. So if we are adding new goods and services, this is going to give you the net domestic product if you're adding the new machines. So the net domestic product is C plus IN plus government spending plus net export. Whereas the gross domestic product, we are spending something additional to that. That is called depreciation. These are the money which we are using. So as even if this is zero, even if new machines is zero, you have to spend something so as your machines are not downgraded. They're not gonna go out of the way. They're not broken. They're not stopped. If you want your machine, your computer, your car to work, you have to have at least a certain amount of investment so as it's keep running. As long as you do this depreciation investment, or it's called replacement investment, it's gonna be, so the gross domestic product is the C plus gross investment plus the G plus net export. And what is that? The gross investment is actually the net investment plus the depreciation. So all together, it's the gross investment. So you can say that the net investment is actually the gross investment minus the depreciation. So gross investment is always larger. Should be larger if the new investment is going to be positive. If it is smaller than that, then actually the capital stocks start basically going down. If you want to have more and more capital stock, then more production, you have to make sure that the depreciation is smaller than the gross investment. So I hope that you understand this. And here we have two things. The variables we are talking about, variables, there are two types. We have stock variable and we have flow variables. The flow variables, the metaphor I'm using is always like this. We have a pond or a lake which a river flows into it. So this is water, flow in, and this is a dam, and which is then the flow out. So investment is a flow variable, whereas the magnitude of the water here is the stock variable. So we noted that the stock of the capital is the stock in the previous year plus what is being added newly. So this is also important to understand the notion of investment, which is being explained here. So gross investment is the total investment which is purchased of new housing, plants, equipments, plus the depreciation. And non-residential investment also, I told you that should be here. If this is done by the firms, this is done by the families for residential housing. It's been categorized. This is the way that they have designed it. It's no further explanation I can give. And the changes in the inventories, I already said that GDP is not the total of value of which is being sold. Sold and unsold and sitting in the inventories altogether, it should be in the GDP. And this is explaining the depreciation. So the gross domestic product includes the depreciation. Depreciation is the money which is being used for the existing machines, whereas the net investment is buying a brand new machines, brand new equipments, and etc. So the net investment is after the depreciation is taken out, is become the net. Now the GDP, if you put the gross, it will give you the GDP. If you put the net, it will give you the NDP. So I have already explained the difference between D versus N as national, D as domestic. And now we have also G versus, again, net. Here is net. This is gross. So we gave you an explanation. This is embedded in the form of whether you're using a gross or you're using a net. And the net is after you subtracting the depreciation. If you have information about the depreciation, you take it out. So I can say that gross domestic product is net domestic product plus the depreciation, or net domestic product is gross domestic product minus the depreciation. So that's simple to know, because I already told you that this is C plus I net plus G plus net export, and this one is C plus IG plus G plus net export, and the minus the D. So this is offsetting this, this is offsetting this, this is offsetting this. So I already told you that the net investment is equal gross investment minus the depreciation, didn't I? So we now know where the N and D comes from. It depends on whether you are using for the investment the net investment or the gross investment. So that is explaining that one as well. And for the government spending, I think there is a public finance course which we spent the whole semester talking about the budget of the government. So in that circular flow diagram, we had the government sitting in between, and then they are spending G and they are collecting the tax. Okay, so the budget is tax revenues minus the government spending. There are three possibilities here. It can be equal 0, it can be bigger than 0, it can be, so depending on which one is larger than the other one. A good government is to have the balanced budget. So it collects the tax and serves the people with the same amount. But the people don't mind if the government go to a deficit, as long as they know that they go to the deficit to support the people. But the people would become agitated if they see the government has the budget surplus. The budget surplus is unless they have been in deficit for some times, so they come to the surplus so as they pay the debts. So if the government is in deficit, it means that the government is borrow from the public. And how do they borrow? They print the government bond. It's a way of borrowing, or in Arabic or Islamic, it's called sukuk, made by the government. So if the government goes and borrow from the people, this is possible, the deficit, but the government is borrowing from its own people and promising to pay back the reward for helping the government to help the people. Okay, but the surplus is make the people a little bit angry because they have to tax more than what they spend to the people. So depending on the structure of the countries, the budget might be balanced, might be in surplus or deficit, and the action of the government, as long as it's helping the economy doing well, it might be accepted by the voters, by the taxpayers. But if they find the government is misusing their taxes, then they will overthrow them in the next election. Sometimes the early election is needed for the change of the government. But the most important components is that whether it's been done by the federal or the states in the context of federal governments. Net export is obvious, the distinction between X minus M. Again, we know that net export has three possibilities. It can be equal zero, they call it trade balance. Trade is balance, like government balance budget. And it can be bigger than zero, it can be smaller than zero. If it is bigger than zero, like Oman, it's got trade surplus. Most countries like to be like this. China is like this. And the trade deficit is a problem. It means that the country consumes or imports more than what they export. So that is, for a short period of time, it's okay. But sooner or later, you should bring your economy that you're exporting more than you're importing. Okay, I will stop it here and I will explain I already have explained the income approach, but better to start fresh in the video chapter 6 part 3, and this has already been explained in the circular flow diagram. So bye for now, see you in the next video.